Hey everyone, welcome back to the channel. Right now, the market is obsessed with the same handful of mega cap AI stocks trading at 50, 60, 80 times earnings here. But today I wanted to show you some, other names, some more absolute cash flow machines, companies with real earnings, dividends, real growth, and they're just getting completely ignored and trading at valuations that are very, very attractive. And today I'm breaking down two genuinely undervalued stocks that the crowd on Wall Street and X are sleeping on right now. I mean, these aren't speculative meme plays. These are profitable fortress balance sheet businesses trading at discounts. If you're tired of overpaying for hype and want to buy real businesses at bargain prices, follow this video. First on the list is Palomar, and they're a specialty insurance company. They offer a wide range of insurance products such as earthquake, casualty, fronting, crop, and inland and marine. But let's take a look and see how their recently quarter performance has turned out for them. So, I mean, as you can see, knockout Q3 here, right? Gross written premiums up 44% year over year. Adjusted net income, 70% growth. Adjusted return on equity. I remember I used to have a boss who was like, don't bring anything to my desk that isn't making 15% ROIC and ROE. So it's like an old guy's metric here. But I mean, it's really cool because 26% return on equity, right, is very important for an insurance company. If you think about insurances, it's almost like banks, right? But they actually have to pay out some things, right? Like a bank, people just drop their money in, but when you give it to an insurer, there may never be a claim. So now it becomes, how can we churn this revenue? How can we get a return on the equity we put in to kind of, help out with some of these expenses? And I mean, clearly this company knows where to stash away some money, make it 26% returns on their equity. Like, wow. But taking a look, they have an adjusted combined ratio of 75%. They just recently acquired Gray Surety, and they're starting a repurchase program and have $37.3 million of shares already repurchased. You guys got to check out this chart. I mean, what this company aims to do and achieves is pretty bizarre. So, I think you have to start with the guidance implies a doubling of the 2022 and adjusted net income in 3 years and doubling the 2023 adjusted net income in just 2 years. And you can see that they're on track already to hit both. I mean, these are lofty goals and they're hitting it. So just to walk you through an example, if you look at 2022, they had an actual $71 million in net income, and they go times that by two. That's our goal for 3 years from now, 142 million in net income. Well, they're already estimating 215, so they already blew that out of the water. Fast forward to 23, they're like, all right, we made 93 and a half. We're doing 187 in the next 2 years, and they're already on track for 212. I mean, they just made an adjusted net income in 2024 of 133.5 million, and they're saying we need 267. I mean, it's only been 12 months estimated, right? We don't know where these last 3 years are going to pan out. And they're not that far off from it already. I mean, the company's growth in adjusted net income is exceptional. And this isn't, a 1 quarter thing, a 1 year thing. I mean, this company's been executing for 4 years now. I mean, take a look. We have 2022, 2023, 2024, 2025. Look at these numbers. Growth rates at 32%. And now in the recent Q3 2024 and Q3 2025, 44% growth. Profitability was at 37%, and more recently at 70%. Just the returns on equity. Look at this. These guys don't miss. 26% return on equity. Oh my God, take my money. And I pull up here their valuation metrics just to take a look, right? Because we know this company's a rule of 40 in the sense that, I mean, you don't even have to look at the bottom line. Their top line's growing so quick, boy, they got that covered there already. But they're profitable too. So I mean, you would expect at least a 30 times earnings on a company with growth rates and the top line and bottom line, revenue and EBITDA like this. But when you look at price to earnings, it's actually trading at one of its cheapest valuations in 4 years, right? I mean, it was at when it came onto the market, it was at about 13.9 and went up to 14.5, 20 times. And now it's down to 14.6 times earnings for a company that's 26% return on equity, a rule of 40 company. I mean, Warren Buffett said about insurance companies too. I mean, and I'm not going to spend a ton of time here, but basically 2026 and 2027 are growing at analyst consensus and based on industry reports, guidance from management, historical profitability levels, we're tapering it off a little bit each year and eventually down to, 2% in the terminal there. For an EBITDA margin, it's bifurcated in the sense that for 26 through 35, we're using a 25% margin. I think they can wiggle their way on up to about 28% in the terminal. Company's an insurance company, so it has, very little capital expenditures, right? They're not an industrial company making electric vehicles or something. Very light CapEx, 3% range, using a discount rate of 10%. That gets me about $5.7 billion in EV, and then they have a net cash position of about $111.7 million, which gives them just shy of a $6 billion equity value. They have 26.5 million shares trading. I have a price target of 223. It's trading at 130 for a margin of safety of 72% on a roll of 40 company, giving you 26% return on equity. All right, the next stock on my list is Molina Healthcare. And as you can see from this chart, boy, he got chopped up. Oh my God. Basically, what's happening is that it's dropped over 50% this year and 27 in the last month. The main reason being their latest earnings in October Q3 2025 were a little rough. Okay. People insured under their plans, especially in Medicaid and the ACA marketplace, have been going to the doctor and hospital way more than expected. So medical costs exploded, profitability went down. They pushed their medical loss ratio super high, 92% in some areas, which basically means they're spending 92% of the premium that they collect on claims instead of keeping it as profit. And because of that, Molina in their Q3 earnings slashed their full year 2025 profit guidance from around $24 a share all the way down to only about $14 per share. Now, I would like to add that, a lot of these are inflated costs in my eyes. They're temporary, right? During COVID, right, we have to go back to the crux of the problem. The government paused kicking people off Medicaid. Okay, doesn't matter what the insurer said, you had to keep them on. So millions stayed enrolled, even if they no longer qualified based on the insurer's guidelines. I mean, that left insurers like Molina with a much sicker, much higher cost membership on average, because the remaining patients need way more doctors visits, hospital visits, behavioral health, prescriptions. The market hates when companies cut guidance like that. It makes investors worry the problems will stick around. On top of that, now there's additional uncertainty because of the new Trump administration talking about big changes to the Affordable Care Act, ACA, Obamacare, and possibly sending healthcare money directly to people instead of through insurance companies like Molina. But since Molina makes a lot of money from the Medicaid and marketplace plans, any policy shakeup scares investors. Thing that I forgot to mention was right. The company trades at a $10 billion market cap and makes about $11 billion a quarter, or 44 billion a year. Just to put that on your radar. But I think it's interesting to use sites like Polymarket, right, to kind of give you some insight into what's going to happen, right? Because what's going on with Trump and ACA and Obamacare directly affects Molina. And as you can see from the Polymarket, we got a serious jud up, right? Almost from 20% to 59%. The odds skyrocket skyrocketed that the first enacted funding bill will include an ACA premium subsidy extension. And Molina Healthcare derives 10 to 15% of its total premium revenue from the ACA marketplace. It's one of the insurers with the heaviest exposure to this segment, along with Centene and Oscar Health. If the subsidies expire at the end of the year, analysts estimate 4 to 8 million people drop coverage nationwide. The remaining pool becomes much sicker and much more expensive, and Molina and peers have already filed massive 2026 rate hikes in insurance prices to prepare for this. Molina requested 30% average increases and up to 41% in places like Florida. And again, with this market jumping to 59% yes and still climbing, reflects a growing belief that the Democrats may force at least a short term or partial extension into the next must pass government funding bill. And for Molina, that would be good news because any extension, 1 to 2 years, delays the enrollment cliff and adverse selection, right? It gives Molina that time to reprice or just exit the bad markets gracefully. I mean, it removes the biggest 2026 overhang that has been hammering the stock. And the stock could trigger a sharp relief rally, in the whole managed care ACA group, Centene, Oscar, and Molina Healthcare. And this might be the biggest value disconnect in the entire market. I mean, Michael Berry just went long, and honestly, it makes perfect sense, right? With revenue hitting 44.5 billion, compounding 18% since 2019 and 11% year over year. Yet the PE's collapsed to 8.5 versus a historical 19 times. I mean, the market is treating a steady giant healthcare compounder like it's falling apart. These are short-term tailwinds. These It's not going anywhere. And the valuation becomes even harder to justify once you look at the balance sheet. 8.5 billion in cash, 3.9 billion in debt, $7.5 billion market cap. I mean, they have an enterprise value of 2.5 billion, and they have an EV to EBIT of 1.6 times. This is net cash territory for a scaled giant health insurer. The company is trading like it's extremely distressed, but it has a fortress of a balance sheet and is in discussions with raising premiums in every state. And I see a lot of people get worried that there's negative free cash flow for the first time in a long time at Molina Healthcare. But I would just like to point out one, there is a one time settlement on a risk sharing mechanism. And two, there's a lot of unfavorable timing of, receivables and payables that's, contributed to that net working capital adjustment in the cash from operations. Mostly it's temporary and working capital driven. I mean, Molina still has a very strong underlying profitability with 2025 adjusted earnings per share guidance of $14. Premium revenue is going to be increasing 10% year over year, and a bulletproof balance sheet, right? We're talking RBC ratios of 340%, plenty of subsidiary dividends available. And take a look at their valuation metrics over the last 4 years. I mean, this was a company trading at 17 times earnings and has dwindled down to 11. This is a company that used to trade at about half times revenue, now trading at a tenth. I mean, this company has been devastated, and it is a titan in the industry and is not going anywhere. All right, that's all I had for you guys. Let me know in the comments if you're buying either of these. I hope you got something out of it. Until next time.